The COVID-19 pandemic upends the global oil market, crushing demand while supply remains high.
The collapse in demand is completely unprecedented.
These are wild and crazy moves. This is truly a global problem, and we need a global solution.
Prices plunge, dragging down producer profits.
We've all given up trying to predict the price of oil. I think we learned that early in our careers, and we certainly don't control it.
While we didn't expect this exact circumstance, we were prepared for it.
How did it happen, and where do we go from here? Join me for a coronavirus special report, Crude in Crisis. Hello and welcome, I'm Alix. COVID-19 brought the global economy to a screeching halt, and one industry hit particularly hard was oil. The coronavirus, oversupply, leverage, and technicals all played a part in this historic catastrophe, and it all came to a head April 20th. Black Monday, the day oil prices went negative. Here's how we got there. First, February. The coronavirus already shut down most of China. Everyone still expected a V-shaped recovery, and most still thought this was just a China story. Towards the end of the month, cases in Italy started rising and prices started to roll over. The ugly March. March 6th. Prices fall the most since 2008 after Saudi Arabia and Russia were unable to reach a production cut deal. This led to super contango, where prices today are $10 or more cheaper than prices a year later. Soon after, the WHO classified COVID-19 as a pandemic. A little over a week later, the Fed's surprise Sunday rate cut failed to protect markets. President Trump warns the U.S. will be fighting the outbreak until August or later. Equities sink and Brent breaks below 30. Cases and the death toll rise all over Europe. California and New York now shut down. Then comes April. Demand craters, storage starts to build. Some U.S. oil producers call for a joint Texas cut. President Trump helps broker a deal between Russia and Saudi Arabia amounting to a global cut of 9.7 million barrels of oil a day, more than 20%. It's too late. April 20th. The day before May oil futures contracts rolls over to June. If a trader hasn't already sold the contract, they could be on the hook for taking the physical oil, only this time there's nowhere to put it. Selling intensifies. May U.S. oil prices hit a record low of negative 40 until demand recovers. It's oil in crisis. Every week, 50 million barrels of oil go into storage. Tankers float at sea filled with oil. Bankruptcies mount, producers slash rig counts, and axe future investments. Some even cut their dividends. Here are what some big industry players are saying.
You'll never see that again in history, I don't believe, where they have to pay you. They have to pay you to take their oil, which was up to $35 a barrel. I mean, it was just an interesting point in history because, again, you got to look at risk-reward. And sometimes when you do those futures, and you know, they have funds that do the futures, and the same darn thing, again, as you had in '08 or in any of these times before the market really breaks. And, you know, playing in the future market in the oil game, or in any commodity for that matter, is not for the faint of heart.
We've all given up trying to predict the price of oil. I think we learned that early in our careers, and we certainly don't control it.
We just refuse to sell our crude at these kinds of prices.
While we didn't expect this exact circumstance, we were prepared for it with a strong balance sheet, a low break-even, and a flexible capital program.
Our expectation is that we see a softer market in June relative to the announcement that we made in May. So we fully expect that we'll be curtailing more production when we hit June, just given the early indications that we see on prices for that particular trading month.
Everybody needs to pitch in. This is truly a global problem, and we need a global solution. We are calling for a roughly 20% cut from the state of Texas, and candidly, that might not be enough. What we need is a symphony of solutions. Operators have to do their part. They have to cut. States need guidelines so that this is done in an orderly fashion and fair across the board. On top of that, other countries need to pitch in: Canada, Norway, Mexico, Brazil, and of course, the big kahuna, OPEC Plus.
Some producers are going to have to cut 10%, some are going to have to cut 20%, some are going to have to cut 30%, and some will not be able to sell their oil because they don't have the power or the stroke or the contracts to get their oil to the Gulf Coast. So there's going to be all types of ineffectiveness or unfairness among all the producers in the state of Texas. Something has to be done, and it has to be done fairly. If not, the small and medium producer will not be able to sell their oil, I predict, for several weeks to months until this virus ends.
We have a situation where we have excess supply. Inventories and storage are filling up. Cushing is 70% full. People think will reach completely full sometime in May. And we're very fortunate to have a very large trading organization and have been able to find a home for our crude, a physical home for our crude. But not everyone is that fortunate.
We came into this with the strongest balance sheet in the industry, a very low break even, and a very flexible capital budget. So we're in control of those choices. And the market signal right now isn't calling for more near-term production. So that's why it makes sense to reduce capital in the short cycle part of our portfolio.
Our break even in 2019 was around $56. So going to 35 by next year, I think, is the right thing to do, and we'll drive it lower if we can. The economic uncertainty here, I think, is immense on how this recovery is going to play out over the coming months. But we're very focused on the basics of the business.
We'll see production here in the month of May down probably 200 to 300,000 barrels of oil equivalent per day, and June, same range or perhaps even a little bit greater than that.
We're going to take capital down by 25% this year, maybe another $1 to $2 billion next year. We're taking $2.5 billion out of our cost base by the end of next year, and we think we can get our business to a break even. Capital is obviously a huge lever for us. Planning to spend around $15 billion. We'll take that down to 11.5. We'll take $1 billion out of our lower 48 business, for example.
There's too many names for investors to invest in these days, and these assets need to be run more rationally. They need to be run for improved financial returns and better capital allocation. So I think there is room for consolidation in this business, and but I imagine today the conversations inside the boardrooms and management teams all about what do we do tomorrow, and not think about the long term. So I don't think anything's going to happen really quickly, but structurally something needs to happen in this business.
There will be no consolidation because people do not want to buy companies that have too much debt. And so there'll probably be only 10 independents left. What's important is energy security and energy independence.
I think oil markets will be well supplied as we come out of this, and so the price signal will be modest as we go through a recovery. But we've found ways to make the Permian Basin highly competitive. It's attractive, and even at low prices can carry positive economics with it. And so I think the fundamental equation there is strong.